The two biggest private equity firms may have cracked the code for buying banks. People familiar say Blackstone and Carlyle Group are teaming up to take over First Republic Bank. It would be the second such deal in 2 months, and assigned buyout firms are abandoning attempts to take over lenders on their own. Bloomberg's Jason Kelly wrote this exclusive story. And Jason, a great story. I mean, tell me, though, why are these private equity firms, why are they now targeting banks?
Well, banks, as you know, are in trouble. I mean, no one who's been alive for the past couple of years and seen the effects of the global credit crisis could argue with that. We've had 37 banks in the U.S. fail so far this year, and that's a big opportunity for private equity because banks are cheap and they need help, and the government needs private capital to step in and provide that aid.
And the thing that has stopped them historically has been what? The
thing that stopped them historically is that this is a highly regulated industry, as you know. Now, there are a lot of arguments that the regulatory system broke down, but even so, these are institutions that the government keeps a very close eye on. They insure the deposits of yours and my money in banks. And that has always made a lot of private equity firms a little squeamish. They can't do the things that they would do for a plain old vanilla industrial company.
Right. They don't have as much free reign
That's exactly right.
in that industry. Then tell us, is the regulatory, is the regulatory landscape, is that changing right now?
Well, there's a real push and pull going on. And what we see from the political perspective and from the Obama administration's perspective is they see this need for the capital to go into the banking system. They know they need it. Public investors have been a little bit skittish, as you know, about investing in banks. They've been in some, they've been out of others, and some have gotten burned along the way. But they also are a little wary of rewarding Wall Street for a situation that, at least the perception is, they helped create.
Well, then given that, how are these deals going to be different going forward than the deals we've seen, in the leveraged buyout boom in the, 2006, 2000, basically pre-crisis?
Right. Well, the leveraged buyout boom was largely characterized by huge public to private deals. So from TXU to Dunkin' Donuts, these were big companies, publicly traded companies that were then taken private by a single buyout fund or a group of funds. What we've seen here is these guys getting together with minority stakes. They're having to collaborate with each other. They're not allowed to have a controlling interest. Again, the government's concerns about private equity or Wall Street run amok. And so they're sort of negotiating that environment to have passive stakes, but they still think they can make a lot of money.
Is there any way, though, in that structure, that club structure, I guess is a terminology for it, for them to exert some sort of control, even if they do have just minority stakes?
Well, the way that they get into it is basically they go in with a group of, what they would call like-minded investors, and these are some of the biggest names in private equity, as you mentioned. And typically what they do is they get together and they pick an experienced bank manager. So in the case of Bank United, a guy named John Canis, who ran Capital One before he went on to do and is now running Bank United.
Interesting. Well, then in that sense, then, could the Fed put up any barriers to that? I mean, if they could find these types of loopholes, or could the Fed do that? Or
they could, and what a lot of the private equity managers we've talked to talk about is this political risk that's looming. Everybody talks about what happened with AIG and compensation, and they know that the government is keeping a very close eye on how much money these guys stand to make. And so there is fear as they do these deals, again, highly regulated. The government's really watching after it, that if they make too much money, there could be consequences down the road. Nobody can really tell.
No, indeed. And okay, so Jason, then tell us, essentially, though, what are the firms? What are the firms likely to succeed in all of this?
Well, as you mentioned, the world's two biggest private equity firms, Blackstone Group, based here in New York, and Carlyle down in Washington, have active practices on this. You see other names like Colony Capital, which made its bones back in the RTC days in the early 90s, getting into this arena. Lightyear Capital, Don Marin, the former chairman of UBS Payne Weber, is coming in. He has a firm that specializes in these sorts of deals. So there are specialty firms, and then there are big firms who have specific practices dedicated to this area.
Okay, Jason, very interesting. Thanks so much for shedding light on this side of the story. Jason Kelly, our Bloomberg reporter.